Today, we are joined by Dr.V.K Vijayakumar, Chief Investment Strategist at Geojit, to navigate today's highly uncertain market landscape and uncover where the smart money is moving. In this episode, he breaks down the sharp IT sector sell-off, explains why posing your mutual funds SIPs could be a costly mistake, and analyzes whether new 35% gold and silver allocation for equity mutual funds can act as a true safety net. Welcome, sir.
Thank you, Abhilash.
So there has been a sharp sell-off in the IT sector. Which sectors look attractive now?
This year, the worst performing index has been the IT index. When the Anthropic shocked the world with their Claude co-work, Indian IT companies took a very big beating because most of their businesses will be impacted. Many segments, not most, many segments of their business, particularly coding, will be impacted. So the index is down by around 20 to 25%. But mid-caps are doing well there. Particularly some mid-caps are doing well, but large caps have been impacted. Similarly, the real estate sector has been impacted. 13 to 14% correction. There has been 9% correction in banking index, but then bank stocks have been doing well. Banking sector is doing well with good credit growth and decent profits also. But because of FII selling, bank index performance has been poor, negative 9.5. But then there are some segments which are doing exceedingly well. The best performing index, I think, is the power index, which has appreciated by 25% in this weak market, 25% return year till date. Similarly, the metal index has jumped by 15 to 20%, giving excellent returns. These segments will continue to do well, particularly power will continue to do well because due to this data centers. Big investment is going to happen already started in data centers in India by the global MNCs. So power will continue to be in demand. But then some segments which are likely to do well going forward. One is contrarian investing. The best sector the next 1 year will not be the sector which performed best during the last 1 year. Perhaps the worst performing sector can turn out to be a good sector also. That also is possible. So the banking sector, which performed poorly in spite of good profitability and good revenue growth, is a contrarian investment now. You'll have to wait for good returns. But then if you have a waiting period of 2 years and 3 years, that is a very good bet now. Similarly, pharmaceuticals. Pharmaceuticals is a strong and steady play as far as India is concerned. So many companies already have done well. They will continue to do well with more than 12% earnings growth in FY27. That is possible. Automobiles is one segment which has benefited substantially from the GST cuts affected last year, and although also the income tax relief provided by the government through the budget last year, and also the low interest regime because of the repo rate cut by the RBI also helped in the boom in the automobile segment, and that is continuing. There might be some slowdown in some subsectors like medium heavy commercial vehicles. But then altogether the industry is doing well. I was looking at the automobile sale numbers of May, the last month, May. Passenger vehicles have done exceedingly well. And also segments like large commercial vehicles of some companies are doing very well. Two-wheelers in some segments are doing well. And the valuations are not excessive. So automobiles is one segment which investors can look to for investing. Then there are the platform companies which are now which have corrected and are available at decent valuations. Then there is the other sector which is the capital market related sector. the stock exchanges, multi-commodity exchanges, depositories, wealth management companies. These are the sectors which are very resilient and likely to continue their resilience in this year.
So equity mutual funds are now allowed to allocate 35% of their investment in gold and silver. Can this be a safety net for investors in the event of a market crash?
Well, SEBI introduced this change, perhaps anticipating big volatility in this uncertain environment. If things turn from bad to worse, and if there is a correction, a sharp crash in the market, then, well, exposure to safe haven gold will bring some stability into the portfolio. That may be the reason why SEBI introduced that change. But personally, I feel that mutual funds, even though small cap, mid cap and flexi cap funds can in theory increase their exposure to gold and silver up to 35%. They are unlikely to do that because these metals are performing poorly this year. This year, in dollar terms, gold is down 22%. In dollar terms, silver is down 43% from 121. So instead of imparting stability to the portfolio, it will cause more depreciation in the portfolio. Therefore, you need not invest in funds which have 35% exposure because this segment is not doing well. And particularly in the present context when dollar is strong, gold and silver are unlikely to perform well. When dollar is weakening, they will appreciate. That is a broad classification. So one has to be careful in this change.
What are the threats to the economy and market, and what are the opportunities?
The possibility of a below normal monsoon, but a below normal monsoon is not a threat. But if it becomes a drought-like situation, then it can be a problem because agricultural output will be declining. But during the last 3 years, we had very good monsoons. Reservoir levels are very comfortable. More than 55% of the acreage and the food grains are now under irrigation. Therefore, even if there is deficiency in rainfall, it is unlikely to be a problem. But if there is a drought, it can be a problem. Coming to opportunities, I would say it is more a desire on our part, more perhaps a wishful thinking in the short run, but it is likely to happen in the medium to long run. The AI trade, artificial intelligence trade. The big beneficiaries are, as I have explained before, South Korea and Taiwan, who are the global giants in this computer chips and memory chips. They are the giants. They are making all the money, not the super scalers in the artificial intelligence space. There we do not know who will make big money, who will lose out. Sometimes there are reports that it will be a winner takes all. 1 or 2 companies making all the profits, others losing out completely. But these chip makers are making money, and that is why Kospi is up 166% year till date, and TAIEX is up 102% year till date. So, but this will not continue for long. We know from our experience in the market that no sector continues to rally for long. There will be sectoral rotation. And there are experts who believe that there is a valuation bubble in some of these stocks. Personally, I believe the valuations are not high, but unexpected things can happen, and there can be disruptive technology which can reduce the demand for these chips. We do not know. In that case, there can be a big sharp correction, even crash. Sometimes when there is a correction, Samsung is declining by 8%, SK Hynix is declining by 12% in one day. So even without a disruptive technology, so that is one possibility. So if there is a correction in this AI trade, then it can turn out to be, assuming that it will not be a big crash that will rattle all the markets. If it is a orderly correction, then money will start moving into non-AI stocks in which India is a very good player.